Hi, welcome back. My last two sessions have been about bubbles, and in many ways, this one is a byproduct of that discussion. Over the last few years, we've seen companies' market capitalizations reach into the trillions of dollars. In fact, a few weeks ago, Nvidia hit a $5 trillion market capitalization. And when you get a market capitalization that big, there are two sets of responses you get. One is from what I would call old-time value investors who look at 5 trillion and say, no way. No company can ever be worth that much. And by extension, if you're priced at for 3 trillion or 4 trillion or 5 trillion, you must be overvalued. At the other end are what I call AI true believers who look at the $5 trillion market cap for Nvidia and rationalize it. It's a big market. Nvidia makes the best chip and everybody needs its chips, and therefore it should be worth 5 trillion. As somebody who invested in Nvidia early in 2018 and has held much of that holding through the last 3 years as Nvidia has risen, I can find some common ground with each space. I know you do know that I think that Nvidia is overpriced right now, and I've been open about that, but I do think that at different points in the last 3 years, I could find a way to buy Nvidia as an undervalued company. And in this session, rather than address the question of whether Nvidia is overpriced or underpriced, I'd like to give you a tool for you to make your own judgment. In fact, before I do that, let's talk a little bit about these market cap thresholds that we're seeing that are being breached. If you go back more than 100 years to 1901, U.S. Steel became the first publicly traded company to have a market capitalization that exceeds $1 billion. Doesn't sound like much in today's terms, but at that time it was a huge number. It was a third larger than the U.S. budget that year and made U.S. Steel by far the biggest company in the market. U.S. Steel was created by consolidating, by bringing together multiple steel companies, and with Andrew Carnegie and J.P. Morgan leading the push to essentially, for lack of a better term, to monopolize the steel business. In 1955, GM, at that clearly the dominant company in U.S. markets, and in fact the saying was, as GM goes, so goes the market, became the first publicly traded company to have a $10 billion market cap. Now, as you go to 1995, 40 years later, GE became the first publicly traded company to have a $100 billion market cap. So you're jumping in tens now. I'm going to bring that multiplier down. In 1999, 4 years after GE at $100 billion, Microsoft became the first company to have a $500 billion market cap. Peak of the dot-com boom. It took 19 years before that threshold doubled. In 2018, Apple became the first company with a $1 trillion market cap. 2 years later, Apple broke that record by reaching a $2 trillion market cap. And in 2022, it hit a $3 trillion market cap. So 1, 2, and 3, Apple was the first company to breach those thresholds. In 2024, Nvidia saw its market cap at $4 trillion. And a year later, its market cap went to $5 trillion. Just to give you some perspective, Nvidia in 2021 was a $500 billion company. It reached a $5 trillion market cap. Now, along the way, I've also tracked the revenues, the revenue growth, and the net income in the years in which these companies hit those thresholds. Why? Because I think there's some lessons we can learn from history. First, if you look at the substance of these companies as they cross their thresholds, from US Steel in 1901 to Nvidia in $5 trillion, there's something you notice. In much of the 20th century, companies hit those thresholds once they delivered the bulk of their value. Their high growth was behind them. They had the revenues, the operating income. In many ways, they'd earned the right to be there with what they'd already done. Now, without passing any judgment, if you look at the 21st century, that's shifted. Apple, the shift was not as much because it was a company delivering hundreds of billions of dollars in earnings and cash flows. But then you get to Nvidia and the other companies hitting $1 trillion marks. You're now seeing markets put into market cap even for the largest companies, a component for growth that is pretty significant. In fact, building on that same theme, if you think in terms of the corporate life cycle, the framework that I'm very fond of, the companies that hit the market cap thresholds in the 20th century were mature companies. Companies, I wouldn't say with the best years behind them, but the best years essentially kind of leveling off. In the 21st century, you're seeing more companies getting to the top of the market cap table while still being growth companies. In fact, if you look at the Mag 7, none of them are mature companies, with the exception of Apple. Many of them still have double-digit growth. Now, as an investor, you might say, well, what does it tell me when a company beats a market cap threshold? Not much, because you look over history, there have been times where buying a company after the market cap threshold could have helped you, like Apple in the case, you bought in 2018, 2020, or 2022. Buying Microsoft in 1999 would have been a loser strategy, at least in the near term. But even there, extending the time horizon would have given you a different result. I would love to give you a simple rule of thumb on this, but there is really nothing you can learn as an investor from just looking at a company breaching a market cap threshold. But let's talk about what happens when a company reaches a market cap threshold. Discussion ensues, right? Well, one side says the stock is overpriced. Why? Because that number is a really big number. The other side, no, it's underpriced. And these debates often go nowhere because it becomes a he said, she said, different opinions, different perspectives, and there's name calling involved. Having been on the receiving end of that abuse for some of my valuations, I'd like to give you a different way of framing this question. Instead of asking, is Nvidia cheap or expensive at $5 trillion, what if I asked a different question? What revenues would Nvidia need to deliver to justify that market cap, a break-even revenue? By focusing on revenues and margins and reinvestment, we bring the discussion back to things of substance about businesses. You're saying, how am I going to do that? I'm going to draw on a tool that is not something I invented, but it's age-old. This tool, while we call it a DCF, it's just an intrinsic valuation. It values a company as a business based on its cash flows. Since we're talking about market cap, which is an equity value, I'm going to focus on the intrinsic value of equity. The intrinsic value of equity is just the present value of the cash flows you will get as an equity investor. Sounds abstract, right? Cash flows to equity are cash flows left over after every need has been met. Taxes, reinvestment, debt payments. The cost of equity, which is the discount rate, is the rate of return equity investors demand for investing in equity. Sounds again like an abstraction, but it's something we do every time we put our money in a stock. You discount the expected cash flows to equity at the cost of equity. What you get is the sum of the present values, the value of equity. This is a standard equation. But let's extend it and simplify it by looking at what the value of equity is in a company that's in steady state, stable growth, effectively growing at or below the growth rate of the economy. I've essentially taken that intrinsic equity value equation and broken it down into components. Let's take each component. Since we're valuing equity, we're going to start with a measure of earnings to equity investors, net income, and we're going to get to the net income by multiplying revenues by the net profit margin. It's just pure algebra, and you'll see in a minute why I've separated revenues and net margin. Present value equations require next year's net income. So the 1 plus G, which is the growth, where G is the growth rate, gets you to next year. And then you're saying, what is that 1 minus G divided by ROE? You don't get to pay out net income. If you want to grow as a company, you've got to reinvest. How much do you need to reinvest in steady state? How much you will need to reinvest to deliver a growth rate will depend on what kind of return in equity you make on your investments. So if you can make a 15% return in equity on your investments and your growth rate is 3%, you will need to reinvest 20%. So G over ROE is the reinvestment I will need to make to get my desired growth rate. And when I net that out, I get the cash flows to equity. Now that cash flow to equity might be paid as a dividend, might be used for stock buybacks, might just even stay in the company as a cash balance, but that's the cash that belongs to the equity investors. They're saying, what's the cost of equity minus G in the denominator? I'll make a confession, and you can spread this wherever you want to. We act like we invented this in finance. This is actually a mathematical equation for an infinite series. You're saying, what's an infinite series? Remember, this is a company growing at a constant rate forever. The G is 3% a year forever, has a cost of equity. The discount rate is the same forever. You have an infinite series. And the value of that infinite series was solved for a couple of hundred years ago by a mathematician. It turns out that you can use a shortcut where you can divide the expected cash flow next year by the difference between the cost of equity and the growth rate. Now remember, this is a mature company growing at a constant rate forever, so the growth rate has to be less than or equal to the growth rate of the economy, 2, 3, 4% maybe, nominal terms. And the cost of equity is what equity investors demand. That's the value of equity in a company. Now I'm going to use this intrinsic value equation to derive my break-even revenues. If you flip the equation around and solve for what the revenues will have to be, given a certain market cap, you can actually, given a market cap, solve for the revenue, and you can see that what determines that break-even revenue are three macro variables. One is the cost of equity, the rate of return that equity investors demand for investing in equity. It's one reason, in fact, I compute my implied cost of equity for the S&P 500 at the start of every year. This is not my desired number. This is what the market is building into stock prices. Start of November of 2025, that number was about 8%. That's what investors are pricing US stocks to earn. Riskier stocks, that number will be a little higher. Safer stocks, it'll be a little lower. Inflation plays its role in this calculation, and it shows up through the risk, through my risk-free rate, or in this case, the treasury rate. The US, that number was about 2.5%, maybe even 3%, and that's consistent with the risk-free rate of about 4%, which is where the treasury rate was. And for the stable growth rate, I'm actually going to cap it at that 4% risk-free rate. Why? Because the risk-free rate includes expected inflation and expected real interest rate. So essentially, the 4% also becomes your stable growth rate, but companies can grow at a lower rate than that. So with that starting point, let's compute the break-even revenues for Nvidia to arrive at a market cap of $5 trillion. Cost of equity, as I said, for a typical US company in November 2025 was about 8%. Nvidia, I'll concede, is a little riskier than the average company. I'm going to give it a 9% cost of equity. Incidentally, the range for 90% of US companies, the cost of equity is between 6 and 10. So you can't make up cost of equities of 15, 20% in the world we live in. The net profit margin and return on equity for Nvidia is sky high. It's an extraordinary company. 53% net profit margin, probably the highest or close to the highest net profit margin of any S&P 500 company. Driven by amazing unit economics, because they don't make their chips, they design them. They get to keep 90 to 92% of what they generate from selling the chips. And the return on equity that they earn is about 64.4%. I know the decimals are overkill, but this is a company with an exceptional net margin and an exceptional return on equity. I know that these numbers will probably come under pressure, but for the moment, let's leave them as is. If you assume that Nvidia can continue to earn that net margin and earn that return on equity, and you add in the other assumption, it turns out that the revenues you will need to break even for a $5 trillion market cap are surprisingly modest. If Nvidia can deliver $483 billion in revenues, assuming all of the rest holds, so the $5 trillion market cap can be justified. What I'm trying to say is people look at 5 trillion and say there is no way, and this equation says yes, there is a way. It's a narrow pathway, but you can get there. Now, this, of course, assumes that Nvidia is already a steady-state company like US Steel in 1901 and GM in 1955, but it's not. It's still growing and changing. And you'll have to wait to get those break-even revenues. And at the risk of stating the obvious, the longer you have to wait and the lower the cash yield you get while you're waiting, the higher the break-even revenues will have to be. For instance, with Nvidia, if you have to wait 5 years to get those revenues and your cash yield is only 2% of your market cap each year, you will have to deliver $678 billion in revenue, not the $483 billion. So the longer you have to wait, the larger the break-even revenues become. In fact, in this table, I've looked at what the break-even revenues will have to be, given the number of years you'll have to wait on one axis, and how much you will get as a cash yield. Notice that at the 2% cash yield, the longer I have to wait, the higher the number becomes. In fact, if you have to wait 10 years, you need 951 billion in revenues. If you have to wait 20 years, 1.87 trillion in revenues. And if you're a cash burning company, you are growing and you're reinvesting so much, it actually ups the ante. So if you're a company with a minus 2.5% cash yield, in other words, you have to issue new equity to keep growing, you can see the threshold revenues you will have to get larger and larger and for longer waiting periods. So waiting does matter. It pushes up your break-even revenue. Now, the other factor, of course, that's driving the break-even revenues, and it's giving Nvidia the favorable numbers that you got, the 483 billion with the huge net margins and the amazing return on equity. At the risk of stating again the obvious, the break-even revenues you get to get to a $5 trillion market cap will be very different if your net margins are lower and your return equity is lower. For instance, if Nvidia had a 20% net margin or 25% net margin, closer to the average semiconductor chip company, and about, let's say, 30% return equity, they would need Nvidia would need 1.1 trillion in revenues to justify the $5 trillion market cap. So as you look at a company, you can see the drivers of break-even revenue. In the case of Nvidia, it's high net margins and high return equity, and being able to sustain them is what allows you to get that high market cap with a relatively modest break-even revenue number. So I decided to extrapolate what I did with Nvidia to the 12 largest market cap companies. You're saying, why do you stop at 12? Incidentally, these 12 all had $1 trillion market caps. You're saying Eli Lilly didn't? It briefly did. So these are $12 trillion or higher market cap companies. I collected the net margin and return equity just as I did for Nvidia. And then I computed the break-even revenues that you would need right now, and if you have to wait 5 years. Let's take the 5-year wait. The 5-year, in the case of Nvidia, that number is 589 billion, and that would require a growth rate of about, and so basically this is with Nvidia's market cap at 4.3 trillion, which it had dropped to by November 20th. You'd need about a 24 point, so the way to read this is you'd need 589 billion in revenues in year 5, and since they're currently at 187 billion, they need to grow revenues at 25.8%. It doesn't sound like much, right? But remember, they've scaled up. That's a pretty impressive growth rate, but clearly reachable. You did the same thing with Apple. You need a 20% growth rate to get about 1 trillion in revenues. They would need, but they're already at 416 billion. Now, if you take Amazon, which is the company closest to a trillion market cap, 691 billion, they will need 1.9 trillion in revenue to break even at their current market cap. You're saying, why that big jump? Because their net margins are only 11%. So unless they find a way to increase those net margins, that target gets much larger. Now, the two companies with the highest break-even revenue growth needed, one is Tesla, which, if its current margins don't budge, that 5.31%, will need 2.15 trillion in revenues to get to its current market cap of 1.3 trillion, which is an 86% growth in revenues. And Broadcom, a beneficiary of the AI boom, which will need about a 39.8% growth in revenues to justify its current market cap. So I've essentially used the approach to get break-even revenues. And as you can see, the drivers of break-even revenues, the higher your market cap, the higher the break-even revenues have to be for every company. So as the market cap rises, the break-even revenues will go up. It's a function of profitability. Companies with great unit economics like Nvidia can get away with lower break-even revenues. But if you're a manufacturing company like Tesla, you're going to struggle. You will need higher break-even revenues to get to the same market cap. Do interest rates and risk premiums matter? Yes, they show up through the cost of equity. One of the reasons I think you saw the surge in threshold market caps in the last decade was low interest rates. And if on top of that you have low equity risk premiums, you end up with low costs of equity across the board that pushes down the break-even revenues you need to justify any given market cap. And finally, companies can be affected by the risk they have, either in their business, you have higher operating risk business, or they add to that risk by borrowing money. Both show up again through the cost of equity. So we know what the drivers of break-even revenues. We can compute the break-even revenues for a company, and there are many people who like this more than valuing a company and comparing to the price, because it seems like a more, less a statement about what a company is worth. But ultimately, you still have to decide, once you've computed break-even revenues for a company, whether those are revenues you can live with as an investor. Now, a few years ago, probably about a decade ago, I devised what I call the 3P test when I assessed my own valuations to see if they passed this test. Is it possible? It's a pretty low threshold. Is it plausible? Is it possible means it can be done. Is it plausible? Basically, somebody's already done that and you can see a pathway to getting there. And is it probable? Which is the pathway you see to getting there is one of the more likely pathways. In the context of break-even revenue, if your break-even revenues are higher than the total market that your company is in, they're impossible. They're a fairy tale. So that's the first test. It's a pretty straightforward test to meet. Is it plausible means a combination of revenues, profitability, and there's a pathway to get there. It might not be the most likely pathway. There might be only a small chance, but plausible means you can get there. Probable means a pathway to get to your break-even revenues with the margins and reinvestment you've assumed are likely to happen. It's one of the more likely pathways. Possible, is it plausible, is it probable? Let's try this out in Nvidia. If you remember, you need about $590 billion in revenue by 2030, 5 years from now, to justify a $4.3 trillion market cap. Is that possible? Clearly, I think it's possible. No, because the total market for chips is much larger than $590 billion. The AI market is growing. It's possible. As I said, it's a very weak test. Is it plausible that Nvidia can deliver $590 billion revenues while leaving margins at 53%, returns on equity at 64%? That's quite a lot of weights you put on there. It's plausible. There's a pathway to getting there, but it's not probable. And that's my basis for viewing Nvidia as overvalued, is not that the combination of assumptions you need to get to that $590 billion cannot be delivered, but they're not likely to be delivered. It's a probability test that Nvidia fails in. But it also means that when somebody says, I'm buying Nvidia and I think it's cheap, you need to listen, because it's not a fairy tale. It's not impossible. It's just implausible given your perspective on the world. I think the company would have the toughest time getting to your break-even revenue, at least based on the table that I showed you, was Tesla. Your revenues have to get 2.2 trillion, and that you're approaching the limits of possibility, maybe even a fairy tale. But here's the escape hatch if you're a Tesla optimist. That's with net margins of 5.2%. Now, if your story for Tesla is about robotics and automated driving, it's very possible that you see those margins go from 5.2 to a much higher number, in which case your break-even revenues might come down and you might get very quickly to possible, plausible, and even probable. Again, it would not be my bet for Tesla, but it might be your bet. Now, once in a while, though, you can have the 3P test at the individual company level being passed, but then you have a bunch of companies and each passes the test, but collectively you have a problem. Call this the big market delusion. You see, what are you talking about? It's usually in the context of a big market that's opened up. The market that you know very little about, but it's big. It could be China, it could be, .com, it could be social media, it could be even cannabis in 2017 or AI today. What happens when you have a big market? People get greedy. And some very smart people get greedy. And some very smart, overconfident people get greedy. There's a reason for this part of the story. What do? They start businesses to take advantage of the big market. So here's how the business goes. If an entrepreneur starts a business to take advantage of the big market, he attracts venture capitalists, also overconfident people who think they've picked a winner in that company. And that cluster goes after the big market. And there are 100 clusters like yours, each thinking that they have the answer to the big market. Within each cluster, if you look at their forecasts, overconfidence, here's how it shows up. They have higher revenues, higher margins than they should really be using, and they get higher values. The bottom line is if you added up the values of the 100 clusters, the sum of the values will be greater. Or in the context of break-even revenues, the break-even revenues you will need to justify the pricing for each cluster. If you added up those break-even revenues, the sum of those break-even revenues is bigger than the total market. In sum, you have individual companies that are possible and plausible, but the collection of companies you've created becomes a fairy tale. Now, I think AI fits the big market delusion. It's a huge market, we don't know how huge. We have little to show for it in terms of actual evidence. Investors have fallen under its spell. They're piling into the AI market in every dimension. Entrepreneurs are starting businesses. Every week I get a half a dozen emails from new AI businesses that have been started. What do you think about my business? And they're coming from smart, overconfident people who've attracted smart, overconfident venture capitalists. And the delusion is not that each of these companies is individually overvalued, but the collection of companies, the revenues, if you add them up, the break-even revenues you would need, are much larger than the overall market can offer. It doesn't work. The big market delusion, I don't think, is an issue in the AI chip market where Nvidia is so dominant, but I think it is an issue in the LLM market, the large learning models, Open ChatGPT, Grok, Gemini, and in the market pricing that the companies owning these LLMs are getting. So, for instance, if you take OpenAI, ChatGPT opened the door for the AI craze. It's priced at about $500 billion. Astonishing if you think about the fact the company delivered revenues of only $13 billion. Why? Because there's not that much in terms of revenue models that they have to make money off ChatGPT. Anthropic, the creator of Claude, which has jumped to the forefront, enterprise AI, has seen its market pricing jump in its last funding round. That's interesting. The funding for OpenAI is coming from venture capitalists, but it's also coming from big tech companies. Anthropic had Microsoft and Nvidia invest in it in November of 2025. $350 billion. It's 500 plus 350, $850 billion already. And Anthropic's revenues were an even more measly $7 billion in the last 12 months. Elon Musk ownership stake, he owns 100% of XAI. It's estimated to be worth about $230 billion, and it gained a huge multiple on the $3 billion in revenues that Grok created or generated in the most recent 12 months. Of course, this is missing the fact that you have Gemini, which is part of Alphabet, and Meta, which has Llama, and Amazon with Nova. The big tech companies each have their proprietary LLMs. And they've all benefited in terms of market cap. A big chunk of Alphabet's rise, or at least a major portion of that rise, can be attributed to the ownership of Gemini. Now, and I haven't even talked about DeepSeek yet, which of course had its moment in the sun. It seems to have faded in the background, but it's still there. But collectively, I would estimate that if you add up the market pricing of all of these LLM companies, you're going to end up with 1.5 trillion, maybe more, that VCs are putting as price tags. And collectively, even with the most generous definition of revenues, these LLMs have revenues of less than 100 billion. If you back out the break-even revenues that you would need, even with, very high net margins, and added up the break-even revenues across these companies, I don't see a way in which the total market is large enough to sustain them. Now, the way big market delusions work out, it's not that every company in the space collapses. There'll be one or two winners, and you can make your guess as to which one or two of the players will be the winners, and they might end up being the Amazons of the analogs to Amazon from the dot-com boom and bust, the companies that win and continue to expand. But a lot of these companies are going to have investors who are disappointed. And you notice that as I've talked about break-even revenues in companies, I haven't talked about managers. You're saying, don't managers matter? Depends. You go back to the break-even list. Aramco is one of the companies on that list, and you notice the revenue growth it needs is almost nothing to get to its break-even revenues. It already is there. It's a mature company. It already is delivering the revenues to justify its market cap. In the case of Aramco, do I care particularly who the management is? Not really. I mean, what can you do? Your biggest assets are already on the ground. The oil will continue to come out. It'll cost you very little, and you should be able to create value. Management matters less at Aramco and Berkshire Hathaway than it does at some of the other companies on that list. Yeah. Eli Lilly, where I'm building in a 26% growth rate, weight loss drugs or other drugs. Management has to do more to get there. The bigger the gap between your current revenues and your break-even revenues, the more you have to worry about management and its capacity to deliver that revenue growth without giving up on the profitability. So Nvidia, if it goes for the $590 billion revenue, break even, but has to have its margin, will not be worth what it's now. And I think that it's something to think about is many of these large market cap companies, what's needed to justify that market cap still has to be done, which means you're more dependent on management doing its job. And here, I want to re-emphasize a concern I've raised, that I raised about 4 or 5 years ago. When Meta had its metaverse fiasco, if you remember, they invested, threw in $100 billion to metaverse, didn't bother to let the market in on what the metaverse was, and ended up with the stock price collapsing. And at that time, I raised the concern that we, as shareholders, have voluntarily, for the most part, given up our power over these companies. Voluntarily in what sense? Many of these companies have 2 classes of voting rights, and we accepted that. Now, we accepted the lower voting rights. So we've given power to founders and top management and reduced our capacity to challenge them. When traditional corporate governance mechanisms like boards of directors and proxy fights don't work, there is unchecked power, and with unchecked power comes overreach. And my concern, especially in the LLM space with Sam Altman at OpenAI and Elon Musk at XAI, is these are more emperors than CEOs. There's really no way to push back on that space. As an investing bottom line, I started this session by talking about trillions of dollars in market cap. And I hope that by the end of this session, you at least are open to the conversation that just because something is highly priced doesn't mean it's overpriced. Just because something has a $4 trillion or $5 trillion market cap doesn't automatically make it overpriced. By reframing the debate about pricing into one about revenues, profitability, and reinvestment, I think we bring up a more healthy conversation that allows us to consider whether a stock, even if it's priced at trillions of dollars, may still be a good buy. I hope you also take the 3P test along with you, because once you come up with the operating metrics, you need to break even on investment. You need to ask the question, is it possible? Is it plausible? Is it probable? Which requires that you assess each company on its merits. That broad rules of thumb and like P, if you will not buy a stock if its PE ratio exceeds X, 50, 80, 100, or revenue multiples that exceed 2. Those are not going to work because it depends on the company and its own operating metrics. It does also mean, as you do this, that we should allow room to disagree. I've never understood why when you find a stock to be overpriced or underpriced, no, even if you believe strongly that's true, why you need to evangelize that. It's not my job to convince you that Nvidia is overpriced or underpriced. And I shouldn't be. And I should be open to the possibility that if you push back and say, I think Nvidia is cheap, I'm willing to listen because, there are pathways that we can use to get to Nvidia's current market pricing or even OpenAI's current pricing. I don't see that pathway as probable, but you might, and I should be willing to listen. And when I do listen, I need to listen. I need to allow the feedback effect to kick in. And that's the fourth one, which is the reality check. As you make your best judgments on a company, you need to leave the door open to the fact that you could be wrong. And what could convince you? New data coming in. So if you priced a company to deliver 20% growth in revenues, and you felt pretty good about that, you thought it was probable, and the company consistently delivers revenue growth of 10%, it's time to revisit your story rather than stick with it. More money is lost by investors sticking with their stories because they love those stories so much than being willing to reconsider because the facts are working against the story. I hope you found this session useful, and I really hope you get a chance to take the spreadsheet that I have that you can use to compute break-even revenues and try it out in whatever company you're interested in. You can even use it for individual projects and ask, if I invest this much, what revenues do I need? But try it out, and I hope you find it useful. Thank you very much for listening, and I'll see you on the other side.